Welcome, ladies and gentlemen. This is Bert Dohmen on September 5th, Saturday, with another chart video to see what the markets are doing now. It was certainly an exciting week. It was painful for the bulls who have not been getting our trading services or our Wellington letter, but those who have listened to us have actually had some great opportunities. As we know, China is the key to the markets right now, globally, not just for the US, not only for China. And this week, China had a 2-day holiday, the last 2 days of the week. So the markets will open in anticipation on Monday. Monday is a holiday in the U.S., as you know, so the world markets will be trading without U.S. investors being able to participate. So that will be interesting. Let's look at the FXI. This is the ETF for the largest Chinese companies that are traded in Hong Kong. Hong Kong is a freer market than China. In China right now, they are arresting investors who want to sell stocks. They are arresting people who want to sell short. They are arresting the top management of the biggest brokerage firms for violating the new rules against selling any stocks. So here we see communism in action. But in Hong Kong, it's a little bit freer. So let's look at the FXI. This is a long-term chart. Each one of these bars here is 1 week of trading. So it goes back to 2013. And you can see here how the market started ramping up. And in the middle of 2015, the stimulus in China was being organized. And then, of course, we had this big up move in the Chinese stock market. And as all artificially stimulated markets go, when finally the stimulus runs out, they go right back to where they came from. And we might want to remember that in the US, where the QE has now been basically reduced, and the market was blown up by the stimulus, zero interest rates, and so on. If we go back to normalizing interest rates, the stock market valuations will normalize as well. Here we can see the FXI. It had a low in early 2014. Old lows are support for the markets. And we can see here it's very close to that line. So that should at least lead to a bounce. Here we go to the prior low, which is more important. And that's the one from 2013. So we could get down to here eventually. And so looking at this, investors would say, well, that's not so bad. We might have a good rally. But I'll show you another chart now of the Shanghai Index. Here's the Shanghai Stock Index. And this is, of course, stocks traded in China. And it's the same time frame. Here we have 2013. And you can see here how this market really ramped up. This was all margin buying. Investors were using leverage of 5 to 1, which means that a 20% decline in the market totally wipes you out. That's it. And I would bet that most investors in China now have been wiped out. They've lost everything. And that is painful. That will have long-term repercussions, contrary to what the Wall Street guys tell you. And here we can see the period where I've drawn a circle. This was when the Chinese government actually started buying stocks. They put about 480 billion with a B dollars into the stock market. It started with 25 billion, then it was raised to 125 billion, and then they raised it to 480 billion because they saw that the smaller amounts were not having any impact. So here, this was the intervention of the Chinese government. This is also where they prohibited selling by large financial companies. They also prohibited short selling, and you can see that it barely produced a hiccup in the market. It was a little rally here. It lasted a couple of weeks, and then it broke down to lower lows. So here we can see that there's quite a bit to go until good strong support levels will be reached. Here, these dotted lines are the Fibonacci retracement lines for those who are advanced technical analysts. Here's the 50% line. You can see that this is where the first support was, at the 50% retracement of this rise. That's the rise from here, to the top. And when it broke through that, it went to the next line, which is the 61.8 Fibonacci retracement, and that was even penetrated. So now we've got the next Fibonacci level right here. This is also the 200-day moving average, and or 200-week moving average, and that might find some support there. So this is Bert Dohmen signing off for now. Be sure to get our services. This is where you get continuing updates. You don't want to invest based on short-term videos like this, or many people I find are actually investing based on promotional emails that they get. This is a big mistake. You need continuous follow-ups. The markets are so dynamic. The markets are so volatile nowadays. You need continuous reassessment from very experienced people. We've been in business for 38 years, which is probably one of the longest of the investment research firms, and we have no conflict of interest. This is Bert Dohmen wishing you a wonderful weekend.